All right, welcome to the final video of this discussion of coronavirus, and I guess the final video for this entire class. Sorry things had to move online. I hate it probably almost as much as you do, but ultimately I'm glad things have been somewhat smooth in this class. So let's wrap things up here. Let's think about what the Federal Reserve is trying to do to stimulate the economy. Right? When we think about ways to address economic concerns, there's the federal government that can be involved, and then there's the Federal Reserve. And as you might have expected, both have been extremely aggressive in trying to steer the economy in these uncertain times. So let's just think about some things that the Fed needs to consider. And this is sort of just brainstorming some of the goals and potential concerns that the Fed might have. One is it wants to avoid deflation. If you recall, deflation is when the dollar is gaining value. That might sound like a good thing, but when the dollar is gaining value, that means that prices are dropping, and that causes consumers to wait to make purchases. If I know things are getting cheaper and cheaper over time, maybe I don't need to buy a house right now, right? So deflation leads to slowed economic growth. And so the Fed definitely wants to avoid deflation. Right now, there are some signs that prices are indeed dropping. For example, prices of imports to the U.S. and prices of exports from the U.S., both of those prices have been going down. So if that trend were to become nationwide, that would be a big problem. Second concern here is to avoid bank collapses. This is not a problem so far. Banks have handled this pretty well. Banks were in a pretty good situation leading up to this, so they've done okay. However, some of the smaller banks have actually been in a significant amount of distress over this last month or so. So big banks, banks that are connected to the Fed have done okay, but then some of these smaller banks that aren't connected to the Fed, things like credit unions, aren't doing so well. People are not making their mortgage payments as readily, money's not rolling in as fast, and so the Fed may have to do something it's never done before and get involved with banks that aren't actually part of the Federal Reserve System. I don't want to get into that too much because that's really beyond the scope of this class, but that might come up in the news in the next few months. The Fed would definitely like to stimulate borrowing and lending. Right? And it's going to think about it from both sides. The Fed's going to think, what can we do to make people want to borrow? And what can we do to make banks want to lend? That's two issues that they need to consider. 4, they need to consider the needs and actions of the federal government. This is always an interesting thing for the Federal Reserve. The Federal Reserve does not control the government, of course. So if the federal government does something like sending out stimulus checks, those things matter, right? And they matter in terms of what the Federal Reserve needs to do next. So the Federal Reserve is going to be responding to what the federal government is doing. And secondly, remember that when the federal government borrows money, it does so through the Federal Reserve. The Federal Reserve actually creates the borrowing that the federal government needs. So the Federal Reserve now has a bigger plate in terms of what it needs to do to keep the economy going. And maybe a fifth thing to recognize here is it needs to think about long-term goals. There's often a direct disagreement between the short-term goals and the long-term goals, right? This is true for the Federal Reserve. I think this is true for anybody. I bet right now you would like to stop watching this video and do something else, right? In the short term, that might make things better for you, but in the long term, it'll make things worse for you. Same deal with the Federal Reserve. It could just go out and just throw money at this problem, but it could affect the long-term viability of our economy, okay? So it has to think about what it can do now without hurting itself in the long run. So, in light of all this, the Federal Reserve response has been pretty much what we would have expected. The general plan has been to increase the money supply. All right? And we just covered this, right? Back in chapter 13, we talked about this at length. And so there's a lot of what we talked about in chapter 13 that directly applies to what we're going to do right now. I wish we were doing this in class so we could talk about it more and discuss it. But the Fed has basically been doing all of the things that we said they could do, right? The Fed has a list of things they could do. They've been doing all of them, all right? So the logic here is that by increasing the money supply, that will help drive down the value of money, which will negate deflation, right? If money is gaining value and prices are dropping, put more money out there. Because when there's more money, it becomes less scarce and less valuable. I hear some people talking about how this is going to cause hyperinflation. They don't really understand what they're talking about, right? People tend to think if you print money, it causes hyperinflation. It can, but it doesn't always. And so in this case, the concern is not hyperinflation, it's deflation, all right? The Fed is trying to get money out there so that we don't have deflation, all right? So we need to negate deflation, provide liquidity to banks and others. Banks are doing okay right now, but this is sort of what you can imagine. Banks have these mortgages, maybe some of the payments aren't rolling in. Banks have done business loans, car loans. Some of that money maybe isn't paying back, right? Maybe I borrow money from a car and I stop making my payments. So the money starts to dry up for the bank. So the logic here is get money into the banks so that they have cash, right? So trying to avoid some of the illiquidity problems. And then lastly, the goal here is to stimulate lending. When there's more money, there's more to loan. And when there's more money, interest rates tend to go down. Both of those things lead to more loans, right? So how can it do it, right? It's got 4 avenues through which it can create these plans. Do you remember the 4 ways the Fed can increase the money supply? Let's see if I can remember them. Open market purchases. That's when the Fed buys stuff. Reduce the required reserve rate. That means that banks can loan more of the money that they have. Drop the discount rate below the federal funds rate. That way the Fed can loan to banks more readily. And then the 4th one, target a lower federal funds rate. Hopefully you recall back from chapter 13 that 4th one is actually the most important most of the time, targeting a lower federal funds rate. Okay? So let's go through those 4 and let's see what the Fed is doing. Number 1, open market purchases. This is just when the Fed buys stuff. The federal government spends money in the open markets. Okay? In normal economic times, the Fed doesn't do too much of this. 30 years ago, they basically did close to none of this, but they've gotten more involved in recent years, and they've gone crazy of late. You can imagine right now is a good time to do a lot of open market purchases. You may hear the term quantitative easing in the news. There are some differences between quantitative easing and the definition for open market purchases, but it's probably reasonable to just put these synonymous in your head. When you hear quantitative easing, think open market purchases. So the Fed has been getting involved with open market purchases. As of April 9th, they have spent $2.3 trillion. That's a lot of money, right? But remember, for the Federal Reserve, no one really has to pay this back because this money is coming out of thin air. The Federal Reserve is creating this money, typically digitally, right? They just say, it's in this account now. They don't even usually print it, all right? So that $2.3 trillion has been created by the Fed. What have they been buying with it? Well, they've been buying mortgage-backed securities. So if I have a mortgage for the house, for my house, you know, a bank may have it, investors may have it through CDOs or something. Well, the Fed's been buying those up. The logic here is, if the Fed buys these up, it does 2 great things. It puts money into society, and it also takes these mortgages off the books of banks, which gives the banks the ability to do more mortgages to try to stimulate the economy. So they've been buying mortgage-backed securities. They've been buying U.S. government bonds, business bonds, and even state and local government bonds. And so in all these cases, the government, rather the Fed, is buying up debt, okay? And a lot of people make a mistake here. They think, well, this is just the banks making rich people richer. And there may be some truth to that, right? If you're a bank, you get to sell these mortgage-backed securities, you get to go out and do new loans, and maybe you make even more profits as a result. But let's not forget that the loan is still there, okay? So if the Fed goes in and buys business bonds, the businesses still have to make their payments. It's just now the payments go to the Fed instead of some other entity, okay? So the Federal Reserve has done a tremendous amount of open market purchases, trying to get money out there in society. As of right now, there is way more money than there was a month ago. The problem is money's not getting spent as quick. The velocity has gone down. So despite the fact there's way more money, there's not hyperinflation because the money's not being used as much. All right, so the open market purchases are definitely happening. A second thing that the Federal Reserve could do is reduce the required reserve rate. Remember that the required reserve rate is 10%. We've assumed it's been 10% in all of your prior videos and everything. And I think in the video where I talked about the Fed, I said the Fed has really never done too much with the required reserve rate. It's gradually gone down a bit over time, but it's never aggressively used the required reserve rate to try to stimulate the economy until now. All right. The required reserve rate, just a few weeks ago, was eliminated. Could be temporary, could be permanent, but there is no required reserve rate right now. That means the banks don't have to hold any money. I'd always tell my students that the Fed, could use the required reserve rate as a tool, but they never do. They'd only do it in a real emergency. So you can imagine if things are really bad, they could do something with it. Well, here we are. Things are really bad, and the Fed eliminated the required reserve rate. The logic here is the banks now can make more loans. They're freed up to do what they choose, and so that should help stimulate the economy. It probably should help. A third thing the Fed could do is reduce the discount rate below the federal funds rate. To be perfectly honest, I'm not sure if the Fed did this. I tried to find some good data out there and I really couldn't. The problem with the discount rate is when the Fed drops it, the federal funds rate will drop so fast that you can't really ever see if the discount rate really went below the federal funds rate. So it's hard to tell for sure if they've done this policy exactly as I taught it in the last video, but what I do know is the discount rate was dropped. So, March 3rd, before really we knew what was going to happen, March 3rd, 2020, this thing was at 2.25%, and just 13 days later, wow, this thing happened so quickly. 13 days later, it was down to 0.25%, which is really as low as it could possibly go. So, we can basically say they've done this policy too. All right, they've dropped the discount rate down. And if you recall from the videos that we've watched in the past, remember that this operates as a ceiling on the federal funds rate. So the federal funds rate is definitely not going above 0.25% unless the Fed decides to change this rate first. Okay? And then the fourth and final policy, normally the Fed's key policy tool, reduce the federal funds rate. Right? This is through targeting. Remember that the Fed doesn't control the federal funds rate, but it can influence it, okay? So, really the same story here for the federal funds rate as it is for the discount rate. March 3rd, it was at 1.59%, all right? Kind of holding tight with where it had been. Back in the summer, they dropped it a bit, and then it was holding steady for a long period of time. And then ever since, it's been dropping up until April 2nd, so about a month later, it effectively hit zero. So the federal funds rate basically got as low as it possibly could. One interesting thing is the Fed could decide to actually push this rate negative. It's never done that before, but some other governments have. I don't really want to get into negative interest rates in this class, but if you're interested, you might think about taking money and banking. It's a class I teach where we talk about negative interest rates quite a bit. Okay? So basically, they've driven this down as low as they possibly could. And how have they done it? Well, through their other policies. When the Fed does open market purchases, there's more money out there. It drives rates down, including the federal funds rates. When it reduced when it got rid of the required reserve rate, banks basically didn't need to borrow anymore. That drove this down. So basically everything else the Fed has been doing has driven this down. Okay? Now let's think about where the Fed is. I'm going to call this the current ammunition of the Fed. The Fed has 4 policies it can do. It can do open market purchases. It can lower the required reserve rate, right? Just restating the things we just talked about. It can drop the discount rate below the federal funds rate. And it can target a lower federal funds rate. The Fed's now in a situation just like they were back in like 2009, 2010. Think about their policies here. Can they lower the required reserve rate now? No, they can't, because now it's gone. There is no required reserve rate. So this policy C is gone. If you think about the ammunition, the things that a Fed can do to fire at the enemy, which in this case is a bad economy, right? One of their tools is gone. One of their bullets they've used up, all right? Second thing here, they could drop the discount rate. Well, the discount rate's as low as it could be. So we're done there. Same deal with the federal funds rate. It's already at its minimum. Could go negative, right? But the Fed has said they're not going to do that, so we have to take them for their word. So what that means is they're left with only one policy, which is open market purchases, which means the Fed is probably, if this thing continues, going to spend even more money buying up assets. That is maybe not a problem, but you can imagine why you wouldn't want the Fed to own tons of assets. You don't want the Fed to control the U.S. economy entirely. And if they're buying up just trillions and trillions of dollars in securities, you kind of have to ask yourself, when is it too much, right? So, what can we learn from it? Thinking long term now, what can we learn? Well, I would make the argument that the Fed needs to basically rebuild its ammunition, if you will, sticking with that analogy. And I'm really hesitant for me to put my opinion on the Fed, because the people who work at the Fed are smarter than me, you know what I mean? But basically, the Fed probably, I'm sure, if it had the choice now, it would say, look, we should have had rates higher in the past. When it decided to get aggressive here, see, the federal funds rate were already pretty low. The federal funds rate was at 1.59%. So you can only drop it about 1.5%, right? There's only so far you could go. If they had pushed rates up to, say, 4% leading up to this, they would have had more room to drop them. They would have had essentially more ammunition. So if you're the Fed, what you might try to do is make sure that you have more ability to drop rates when things get bad, okay? That being said, the people at the Fed, I think they know what they're doing pretty well. They're really smart economists, so it's hard for me to be critical. But you can imagine that the Fed is going to have to think about what it will do next when we finally get over this economic collapse. Will it try to reestablish a required reserve rate? Right? That might be tough, because the banks might get used to not having a required reserve rate. How is it going to sell all these assets that it has? Typically, when the Fed does open market purchases, it reverses those by making open market sales. How is it going to sell trillions and trillions of dollars in assets? It's going to be interesting to see. And that's the end of the class. Thanks for paying attention, guys.